Hello, my name is Connor Myers, and today we are going to be looking at the ratio analysis of McDonald's versus Wendy's. Looking at both of these companies' current ratios, we can see that McDonald's had a significantly better current ratio. The current ratio is showing a company's current assets compared to their current liabilities. We can see that based on this, that both companies have more current assets than they have current liabilities. However, when we are talking about current ratios, we can't just look at 1 year's worth of current ratios and use that to determine whether a company is a good or bad company to invest in. When we look across all 3 years, 2020, 2021, and 2022, we can see that McDonald's has an increasing trend in their current ratio. This is a good sign. McDonald's average, however, was 1.257, which is still less than Wendy's average, which is 1.546. But McDonald's is showing a sign of constantly increasing, while Wendy's is showing a sign of going back and forth between increasing and decreasing. However, the average of Wendy's numbers is overall better. Looking now at the debt ratio is basically total liabilities divided by total assets. Now this is not like the other slide where we had current assets and current liabilities. This is talking about total liabilities and total assets. Generally speaking, a number that is lower is better, and we can see that when we look at the total liabilities divided by total assets, we can see that McDonald's is a little bit over 1, which means that they have more liabilities than they have assets. When we look at Wendy's, we can see that they have 0.914, which means that they have more assets than they have liabilities. If we look at the trends of the debt ratios between the two companies, we can see that McDonald's is decreasing, which is a good sign, because if they continue decreasing, which they have been decreasing over the past 3 years, that means that they are getting closer and closer to having more assets than they have liabilities. If we look at Wendy's numbers, though, they're mixed. They are going up and down in terms of their liabilities versus assets. However, if you look at the average for Wendy's, you'll see that Wendy's overall still has a better assets to liabilities ratio than McDonald's has. When we look at the debt to equity ratio of McDonald's and Wendy's, we can see that when comparing their liabilities to their equity, we can see that neither of them is necessarily in a good situation. Looking at McDonald's, they're in the negatives, which means that they are actually going negative in their shareholders' equity, which we can see in their balance sheet where they start listing the shareholders' equity as a deficit. Now, Wendy's is not in the negative, but they have a very high debt-to-equity ratio. This is not ideal because it means that they have very high liabilities compared to their equity. Looking at the trends of their debt-to-equity ratios, we can see that McDonald's is on a decreasing trend. And that is not in a good way. It means they are going more and more into the negative, which means they're getting more and more in deficit in terms of their stockholders' equity. If we look at Wendy's, their numbers are still quite high, but they are not in the negative like McDonald's is. The profit margins of McDonald's versus Wendy's are very different. McDonald's has a very high profit margin, whereas Wendy's is kind of low. Basically, McDonald's is making more money for each dollar in sales. And what do I mean by that? I mean, as in after expenses are accounted for, they are making more money. McDonald's and Wendy's profit margins both go up and down, but if we look at average profit margins, we can see that McDonald's has a significantly higher average profit margin than Wendy's does. If we look at the dividends payouts, we can see that McDonald's is continuing to pay out its dividends, at least in this year. It is continuing to pay out its dividends, not at the expense of the company. If we look at Wendy's, however, we can see that because they go in the negative, in order to pay their dividends, they are actually going in the negative, which means they are taking it away from the company in order to meet these demands. Looking at their average trends across the years, we can see that McDonald's has an average that is actually higher than the first year that we showed. But if we look at Wendy's average across 3 years, we can see that they consistently stay in the negative, which is not a good sign. The asset turnover of both companies, we can see that they are both using their assets to make sales. We can see, however, that Wendy's edges ahead by a little over double McDonald's in terms of how well they use their assets to make sales. Both companies go up and down in terms of what their asset turnover is each year and across years, but we can see that on average Wendy's has a better asset turnover.